So now let's talk about classifying property. We can classify property in a number of ways. We can classify property as real property or personal property. Real would be like real estate, land, and buildings. Personal property being all of those other types of property. We can classify property as tangible versus intangible property. So tangible being the things that you can physically feel and touch and pick up. Intangible being software, ideas, things that you can't feel or touch. And we can classify property by uses. We can classify property as business property, investment property, or personal property, as we've been talking about earlier. We can also parse property by use a little bit differently. We can talk about property used in a trade or business, which is also known as Section 1231 assets. We can classify property as ordinary income assets, which include receivables, inventory, and depreciable business assets. And depreciable business assets can be 1245 or 1250 property. And capital assets are everything else, everything that's not trade or business or not ordinary assets. Now, the Section 1231, 1245, and 1250 property, those are obviously named after code sections. Those code sections tell us how we treat the gains or losses from those types of property, whether it's capital or ordinary, and how they're netted and how all of that taxation flows together. Fortunately for you, the details of the netting and the taxation are beyond the scope of this course, but it's important to understand the concepts and know that if you have a client that has business property, that it's important that they have competent tax representation to help you calculate the realized gains and how those realized gains are taxed so you can give your client proper tax advice. Now, some types of property is subject to depreciation, and depreciation is actually not elective. The idea of depreciation is that assets used in a trade or business that have a useful life of longer than 1 year cannot be written off in a current year. So a taxpayer, a business, cannot manipulate income by buying a bunch of property and reducing taxable income to zero in a given year. As I mentioned, the IRS wants property to be expensed over the useful life of an asset, and the IRS calls this cost recovery. There are a few requirements to depreciate, so once you meet these requirements, you must depreciate, but you have to meet these requirements in order to fall into this category. As I mentioned, the property must be used in a trade or business. It must lose value over time, so for things like land that typically increase in value, you wouldn't depreciate that. And it must have a useful life of more than 1 year. So if you are purchasing annual software updates, those updates can be expensed because at the end of the year they're no longer useful because you're required to buy the update for the next year. So there are some assets that absolutely cannot be depreciated. Property placed in service and disposed of in the same year. Occasionally businesses will buy an asset, realize it's not the right fit, it's a mistake, they get rid of that asset, no depreciation is allowed that year. Land, as we talked about already. Inventory also is considered an ordinary income asset and it is not depreciable. Equipment used to build capital improvements is typically not depreciable, and assets where personal efforts were used to create the property, when you're putting in your time, similar to when we're talking about charitable contributions, it's hard to value that time, and so therefore there's no value to depreciate. So assets that are placed in service now, and most of the business assets that you'll see, because assets that have been placed in service since 1986, are depreciated under MACRS, which stands for Modified Accelerated Cost Recovery System. MACRS has a system of depreciable lives. It's a statutory system, and so when you place an auto or a computer in service, it must be depreciated over 5 years. It doesn't matter if you always replace your car every 3 years or if you keep your car 10 years. If it's a business auto, it must be depreciated over 5 years. We can see here office furniture is 7-year property. Residential property, which is rented typically, is 27.5-year property. and non-residential property is depreciated over 39 years. These are statutory and cannot be changed. Now, as I mentioned, when we introduced the concept of depreciation, Congress did not want businesses to be able to manipulate their income by buying a bunch of property and reducing taxable income to zero. Now, after they made this general rule, here comes a big exception, a huge exception. It's called Section 179 expensing. And the Section 179 election allows small businesses to write off the cost of capital assets in the year of purchase. So if you're a small business and you buy a few computers, rather than having to depreciate them over 5 years, if you meet the requirements, you can elect to treat them as Section 179 expense, and the entire expense, dollar for dollar, will be allowed to reduce your taxable income for the given year. So you meet the qualifications by only placing in service a certain amount of equipment. It's a pretty high dollar limit, but you can't go over that dollar limit. You can only expense a certain amount of that equipment each year, and these limits vary year by year, and Congress really likes to play with these a lot when they're doing stimulus. So be sure to refer to your textbook for the current additions limit and current Section 179 expense limit for the year that we are currently residing in. In addition, Section 179 expense cannot create a loss. Now, when Congress does a stimulus, they like to put it in the news and say, look what we're doing to help small businesses. And typically what they'll say is businesses are allowed to write off $100,000 of property, $500,000 of property, whatever that new law is. But what they don't say is that those businesses have to be profitable in order to be eligible for that write-off in the current year. So typically when Congress is doing stimulus, it's because the economy isn't that great. Businesses are struggling. Many businesses do have losses, and so they can't immediately take advantage of the Section 179 expensing benefit. But if you have clients who have some income, not enough to offset all of the fixed asset purchases for the year, it is possible to take Section 179 up to your income being zeroed out. And then for the rest of the property that did not get Section 179 expense, you can depreciate it. So it's possible if you buy a big asset, say $100,000 piece of equipment, your taxable income before depreciation and Section 179 expense was $50,000. You can take a Section 179 expense for $50,000, and then the remaining $50,000, which did not get the expense, is eligible for depreciation. So in that sense, you can have a small loss even when you're taking Section 179 expense, but the Section 179 expense itself cannot create a loss. I know it's a little bit confusing, but it's an important concept for you to be able to explain to your clients. So be sure to review the textbook for additional information on Section 179 expense. So I think the final concept that we'll talk about in this lesson is amortization. Amortization is like depreciation for intangible assets. But unlike depreciation, where there's lots of different useful lives and lots of different methods, pretty much everything that's amortized is amortized over 15 years and it's straight line. Now there are some exclusions, so not every intangible asset is eligible for amortization. Interest in other entities, so the pass-through investments, they're not amortizable. Interest in land is not amortizable, just as it's not depreciable. There are limits on software. Software a long time ago used to be amortized because it is an intangible asset, but now technically software is depreciated. Sports franchises are not amortizable, and there are limits on corporate organizational expenses. So corporate organizational expenses are amortizable, but to a certain extent it could be expensed, and so refer to your textbook for the details about that calculation. Finally, there are special rules relating to goodwill. So if you have a client, a business owner who has goodwill, be sure to refer them to a qualified tax professional because those rules about goodwill are beyond the scope of this course. So in summary, during this lesson we learned that basis is an important income tax concept, and it's important because it's part of that taxable gain calculation. The factors contributing to basis include how the property was acquired, expenses relating to the property while owned, and depreciation. And also, mastering basis is an important personal as well as business tax concept, and that's because on the personal return there may be business activity that's reported. And it's important that when your client does have business activity that they do have competent tax expertise, and it's important for you to be able to recognize that so you can refer your clients to that appropriate expertise when necessary. So I hope now you have a better understanding of basis and cost recovery.